Let's talk utilization rates. Credit scores are frustrating. You need credit to build your credit score, but if you use too much of the credit, your credit score drops. That's because there is a difference between credit and debt. When it comes to credit cards, you have a limit on how much you can borrow. That's your available credit. When you have a balance, you owe the credit card company money. That's debt. One of the biggest mistakes you can make that will lower your credit score is using too much of your available credit. How much of your credit you use is called your credit utilization rate. For example, if you have a $5,000 credit limit on your credit card and you have a balance of $1,000, you have a utilization rate of 20%. If you have a balance owing of $4,000, you have a credit utilization rate of 80%. To have a good credit score, you want a low utilization rate on revolving credit like credit cards or a line of credit. And here's the key point. You want to keep this balance low throughout the month. You don't know when your balance will be reported to the credit bureau. Your lender might report your balance 2 days before your payment is due. If you have a high balance, it looks like you're carrying a lot of debt, even though you make all of your payments on time. You want to prove to the credit bureau you are responsibly using your credit card and that you don't need it, which is why you keep your utilization rate low. So, what's the right utilization rate? If you're rebuilding, our experience shows that 0 is better than 30% and you should never go above 50%. So if you have a limit of $500, how are you supposed to keep your utilization rate at or close to 0? Simple. Pay your credit cards early. You don't have to wait until the bill is due to make a payment. I recommend you choose a fixed cost bill like your cell phone or internet. Set this account to be charged automatically each month to your credit card. Next, pay off this balance the same day. After you set this up, hide your credit card so you won't be tempted to spend more than you should. Check your credit card statements every month to make sure this is working and that your balance is 0 on the due date. This will do 2 good things for your credit. You'll have a history of payments and your balances will be low. You're proving that you don't need the money. It's possible to lower your utilization rate by getting another credit card or raising your limit, but having a lot of credit card is risky. You might be tempted to run up your balances, leaving you in trouble with debt again. Also, if you have a lot of credit cards with high limits, even if your score is good, future lenders may not be willing to loan you more money because they think you have too much credit already. You only need to worry about managing your credit utilization on revolving credit, like credit cards and lines of credit. You can't manage your utilization rate on your mortgage or car loan. Those types of loans start with 100% utilization when new and you make fixed monthly payments, so over time the balance owing falls until it reaches 0. Applying for the right amount of credit at the right time can improve your credit score, but using that credit a lot and carrying balances again will hurt your efforts to rebuild. Keep your utilization rate as low as possible.